Did the Federal Reserve at Jackson Hole just admit that they're too late to the rate cutting cycle? More importantly than that, now that they don't want jobs to drop anymore, what will happen if the August numbers are bad? Well, one thing's for sure, we're going to need to be looking at the S&P 500 in a lot of detail, along with the NASDAQ as they're at critical gap fill levels. Will we see a little bit of weakness before strength? Will alternative assets start to do better? Well, a lot of it comes down to one single stock, NVDA. This week, it's going to move over $300 billion at a minimum, according to the options market. And with a massive call wall in its way, we could be going into a huge squeeze event if it is a good result. So join us today as we cover in our special weekend edition stocks, commodities, and cryptos, because there are a lot of breakouts right now, and we need to be looking at them together, whether we're investors or traders. Well, welcome back everyone to the special weekend edition of The Daily Show. My name's Tom, and what a week it was with, of course, Jackson Hole and Powell coming in to make huge moves across the markets. Interesting, the S&P 500 wasn't able to make a new high, but the Russell 2000 went ballistic. More on that coming up in today's show because it was very telling of what Jay Powell is really doing here. Powell said he's more confident that inflation is moving towards 2%. Notice we haven't hit that. But overall, he's like, you know what, we've got it. We've got enough there to go with the rate cuts. And this shows you that they are a little bit concerned. The time has come for a policy adjustment. Rate cuts, timing and pace will depend on the data, but basically lock 25 basis points in. Now let's see whether we get a 50 basis point though, because Powell said there is no desire for further cooling in the labor market. This means that if they start to see weakness in the labor market, they may panic. And remember, Jay Powell and the Fed are always late to the rate cut cycle. So realistically, we've probably needed this for quite a few months already, and now they're about to do it. Now, we do know post Jackson Hole, we can end up getting big swings. The last 2 years worth of swings have been in the vicinity of almost 3% each way, whether it's bearish or bullish. And we also know that the market is now expecting a huge amounts of rate cuts all the way through to the middle of 2025. Take a look at this trajectory change over where we were 30 days ago to where we are now. Now, the market always gets a little bit ahead of itself, so it's unlikely that the Fed will cut anywhere near the rate that the market expects. So this will change quite a lot over the next coming weeks. But now the question becomes, are we in a recession? Are we already in it? Are we not realizing it yet? Is the market deranged? All of these questions come up all the time in the comments section, and a lot of you are very polarized on each side, whether it's bullish or bearish. Here on the channel, we try to look through all of that. We try to bring the data into it, and we look at where we are in terms of the cycle. And you would know that if you've been watching this channel for a while, I believe we're in late cycle. A lot of us do believe this, and we've got to be really careful to the timing. You're probably correct that there is a huge recession on the horizon for the markets, driven basically by debt. Now, you may look at credit card debt, you may look at all these things and say it's here already. Commercial real estate is crashing, all of this other stuff. But realistically, it doesn't matter what read you have. And of course, I have a different read than this that we'll be talking about over the next year. But it doesn't look like we're quite there yet. Now, one of the things that we're going to be looking for is basically the leaders of the world saying that we have solved soft landings, we've got a soft landing and everything's fantastic. Now remember, this is just the beginning of the rate cut cycle. So we need to see people celebrate that rate cut cycle. Then you want to be terrified because it's very unlikely the Federal Reserve is going to be able to navigate a soft landing. Statistically, they just don't do that. Have a look at this chart here. Shopping for rooms, flights and cruise liners slow. Accommodation, airlines and cruise lines all dropping like a rock here in July into August of 2024. And what this is showing you is it's a little bit of a decline in spending, but more importantly, people are just being a little bit, they're questioning what they're doing with stuff. And you will actually see if you go shopping now for flights, they should be a lot cheaper. So things are actually coming down across the board. Mixed messages from the market. The market's clearly trying to figure out what it wants to do next. But I think the thing that's really outlying here is that treasuries have been really buying up. Now, we know this is the most levered position in the markets right now, and I would expect over the next 6 to 12 months, some wild event to occur in treasuries based on the amount of leverage that is literally in treasuries right now. Maybe it'll just be expirations. I don't know. But there is so many people betting on this rate cut cycle being fast and quick and abrupt, and we'll see how that plays. We've also got gold, of course, and the S&P 500 doing well, while the US dollar is dropping and many other commodities around the world are starting to struggle. The breadth, though, is improving. By this chart here from Seth Golden, you can see stratosphere achieved by the breadth of the market, and across the board, basically, breadth is back. And this is a good sign. Remember, we know this earnings season that really what the market is looking for moving forward is IWM and the rest of the 493 stocks in the S&P 500 in particular to start catching up, to start realistically giving good earnings. Now, they've been upgrading those across the path that you'll see soon, and this is leading into us believing that the market is maybe going to start to see some growth in these areas. Now, of course, Tom Lee from Fundstrat, he believes that the IWM is the best investment in the markets in the major indices right now. And maybe he's actually correct. We saw a huge rally hitting into our first take profit zone pretty much straight after the Jackson Hole Symposium speech. And we can also see here that the 493 stocks, excluding the Mag 7, have improved big time. Take a look at this. This thing is flying compared to the Magnificent 7. This is unusual. And of course, when we see leadership by the 493, that can lead into really good returns from the smaller cap stocks. And it's the first time we've seen this in a little while. So something to be, of course, watching when we're looking at the charts. Also, S&P 500 annual performance, the number of days per year we're trading above 1%. We saw another 1% plus S&P day after falling the day before Jackson Hole Symposium. And this brings us into kind of this average period of time. You can see here 2024 basically marking out very close to the average. And generally speaking, when we have this, I would say lower volatility for the year across the board, excluding that VIX 65, we tend to have a more bullish style market kind of with that. Now, you would know that if you've been watching the channel, we've been talking about corporate buybacks. This is the most powerful corporate buyback period of the year, and it seems to be in full force. $5 billion pretty much per day going into the market because of corporate buybacks. But did you know that it looks like corporate buybacks could be coming to an end? Is this the sign of, again, late cycle? Let's have a look at some of these major tipping points. November 2019. Well, we all know what happened in 2020, but remember on this channel, we believe that whether it was the pandemic or something else, that we were already in a period of pullback in the markets. The markets were going to pull back around that time. They were going hyperactive if you were trading during November, December, January of 2020. Before any of this was really known, they were already going ballistic. Then we come to June 2008, 8% total cash on hand before doing buybacks. We're currently sitting at 8.8%. So according to Bank of America, we could be seeing the end of buybacks in the markets relatively soon. This may be the last of the good buyback seasons. An interesting point, because as we know, we've done this chart before, we've got to bring it back. If you're interested in getting that chart back, let me know in the comments down below. But basically, we know that the last 14 years of market growth, buybacks have made up a considerable amount. In fact, it was like a ridiculous amount of the overall growth in the markets. So let's talk about this breadth a little bit more. Up volume versus down volume. Very strong on Friday. This was huge. And we had a 9-to-1 up volume day. And this was the best day since October 2022. Now, we know what October 2022 was. It was the bottom. It's so weird to have that right here. It was the bottom of a major pullback. At the same time, we also have even more wild increasing or advancing versus declining stocks, 14-to-1 or something like that across the board, bringing us to a point where we just don't usually see so many stocks having a great day. It was a broad-based asset growth kind of period, specifically in small cap stocks. Now, this brings us to a question of whether we're still going to be able to go sideways for a little bit, or whether we're just going to go ballistic up and out and start kind of, really rallying here and squeezing in the market. Well, a lot of that comes down to sentiment. We know that we hit 51.6% bullish sentiment, but we also know that really all that matters is the sentiment switch. So where are there more bulls than bears? Are, of course, these numbers getting a little bit extreme? Well, we certainly made a huge switch here when it comes to where we are in the markets. We're not quite into that 35% or 33% really high narrative, but certainly this will be something we want to watch this week, specifically after the NVDA results. Never lose sight of this chart. As we said, treasuries are incredibly levered right now. They've never been more levered in our entire kind of history of looking at these charts. So something will eventually happen there. Think of that as like Japan and the US dollar yen. We talked about it for years, and then all of a sudden, like a click of a finger, it came out of nowhere, and of course it became a problem. That's what I think that treasury's position looks like. We do know that basically the stats of the recent breadth thrusts in things like NVIDIA and stuff are bullish for the next coming weeks and months. And we also know that when we had 11 consecutive higher lows like we did last week, that the stats again are very bullish. So whatever we see here, we've been seeing this for a while, whatever we see here, even if we see a little bit of a pullback to get some gap fills, which we'll talk about in a moment, even if that happens, we have to remain medium term here relatively bullish. So that means that over the next couple of weeks, we need to really be saying, well, it's buyback period, and we know that there are some stats coming up, e.g. when the Fed actually placed the rate cut, that tend to be negative. Remember, Grant's data basically said we'd be up, down, and all around. Only a coin flip of the time would we be bullish in the markets. It was actually a little bit less than that. Now, speaking of Wayne, he's got some great information here, and he's gone through and he said, how do September periods usually go in plus 10% years? Well, you'll notice here, August 27th till September 9th. Well, damn, that is a pretty good stat. 15 up, 7 down. September 9th to September 15th, actually negative towards the markets. September 15th to September 23rd, now getting into the period where the Fed is going to do the rate cut, bullish again. So again, all pretty much net bullish across the board. And then the interesting one that we've been mentioning on the channel for a while, September 23rd till actually, I believe, October 3rd. But this is the period that we need to be watching the most closely because it's the end of September. Remember that mid to end of September tends to be where the biggest weakness is. Only 6 periods up, negative 16 to an overall negative ratio 1.14. Now that may not seem like much, but in a year where we're going to see bigger stats, you'll notice that this is still a pretty big key. And notice again here, September 23rd to October 2nd, when we looked at that other reading from Wayne, shows the same thing. So it looks like the market data stats are pointing towards a potential weakness here, especially later on September. So if we don't get anything here, we go to new all-time highs. I believe that some of these gap areas could certainly be hit later on September. And what I guess I'm saying by that is that like anything, you don't really want to feel FOMO. You don't want to feel fear. If you ever feel those things in the markets, you're probably getting gamed by the market. And we must keep a very good temperament in markets. That's one of the best things. If you ever look at Warren Buffett, Stanley Druckenmiller, any of these guys, their temperament is amazing. They absolutely do not feel FOMO or fear. Earnings estimates were upgrading across the board. And of course, we know that's all about Russell 2000. And we know that when the Fed cuts, the next 3 months will matter. Now, we've had this chart on for a while, guys. And if you're first time here, make sure to subscribe because we saw a flash crash, very interesting, no recession style. Then we usually get a bit of weakness after the rate cut. Again, the stats are kind of pointing towards that. It's like very weird in some ways. Then what happens? This is the question mark. Do we start to see weakness in the market? That won't be good unless you're a bear because that, of course, could be pointing towards significant recession. I believe here on the channel, and I think we all do, that we should be watching the market structure more than the limited data points and the limited news narratives. Remember, the narratives really are where most people lose. If you've been trading for a few years, just think of all those times that you thought something should happen and it didn't, and then you're left scratching your head saying, oh, it doesn't make sense. The market's rigged. The market's not rigged. You're just not reading it properly. And you've got to remember that it's because we're given limited data points and often bad narratives, and you're following the narratives. The narratives are always wrong. One of the things we do know about narratives, though, is that if a 50 basis point cut happens, if the market cheers that on, it's probably not a good thing. Remember, the last 2 50 basis point cuts ended up in significant pullbacks in the market. Let's just talk about how significant it was. Negative 50%. Yes, it was very bad. Plus that. So 25 basis point cuts. Remember, most of these soft cut landings didn't actually last very long. In fact, they lasted kind of like 12 months to maybe 2 years in total. So 1998 and 2019, these are the rate cut periods that we're focused on because we are still inverted when it comes to the yield curves. And we know that certain asset classes, such as our favorite one here on the channel, gold and now Bitcoin breaking out, which is pretty sweet, are starting to move big time. And of course, if we overlay gold, you'll start to see why maybe I'm so bullish on it. Now, of course, we've been talking about $3,000 an ounce and been doing that for now for like $700. But basically speaking, it looks like it's going to get it sometime in 2025. Now, this is well within our parameters. We've talked a lot. Originally, it was like 12 to 18 months. Now we're down to like 12 to whatever it is, 12 months pretty much. And we'd like to see, of course, gold go towards $3,000. Now, this is a pretty big thing. Basically, what it's doing is it's showing that the market's turning partially defensive. And it's also showing that gold's coming out of its lost decade. Gold, let's be real, even if you're a gold bug, let's just cut the crap. It was a terrible investment for a long time. It suffered a lost decade, and gold loves suffering through periods of time. In fact, gold often sucks along with silver. So remember, even if you're a gold bug, it is not always a good time to own gold. But here's an interesting one. Stock to gold rotation. It says here, make trend your friend from High Mount Research. Well, I kind of agree with this in some ways. I wouldn't do so much rotation. There's so much rotation here. It's ridiculous. But what basically is happening here is that we're seeing gold outperform the S&P. Now, when that starts to happen, you're getting a huge trend inflection point. And often, if you notice here, these are the periods where S&P's done better than gold and, of course, overtaken it overall as a percentage. These types of inflection points are really, really interesting because when gold overtook last time, we were going into a recession during this period. And again, we may be starting to see that again. And remember, gold actually overtook the S&P 500 ahead of 2020 as well. So very interesting and worthwhile take into consideration. Now, this week, I don't care about any other stock except for NVDA. Maybe Crowd's kind of interesting as well. But NVDA is the main one, and this is huge. We are talking about a $3 trillion company moving at a minimum, according to the options market, plus minus 12 to 13%. Wow. Can we say anything else? Wow. This is blockbuster stuff. I think that could be one of the largest moves that we have ever expected or ever seen on the market. So expect potential history to be made this week. And we do know that ahead of the Jackson Hole, we had quite a lot of weird transactions going through the markets. We had, of course, the Qs, which were trading around pretty much the same price as they are right now. We had the S&P 500 trading. We had, of course, people trying to possibly close off shorts or even add shorts to their semiconductor position. So they were basically possibly starting to add those. People are starting to make some big bets on the markets. Remember, do not follow these particular dark pools themselves. Follow the price action in the markets. So let's talk about rotation. And is this market good or bad? Well, this is actually a very bullish market. I mean, when you have home builders going ballistic, when you've had weird risk-on kind of positions going ballistic, and more importantly, the financial areas and real estate markets going so well, in the last 5 days, they've been some of the best breakouts. This is not a bearish market at this stage. You can see here on Friday what went ballistic. Solar up 5, regional banks up 5. That's wild. Home builders up 4, and then semis coming out of nowhere with a 2.46 as well. All defensives down the bottom. Everything was green. Every single one was fantastic. So while the market was only up a little bit in terms of the S&P, because it wasn't led by the big tech stocks, we still saw a very good breadth across the board. And this took, of course, our advanced decline line. Take a look at that thing. It just smashed into a new point. So again, it kind of points towards the market wanting to go higher. So that means that if we do start to get pullbacks, let's say we pull back to either of these gap fills, and actually I'll mark them on the charts. Let's do that together. So we'll mark these down just so we know, because it is possible to hit these even though everything's looking pretty bullish right now. And these two levels are very, very important to the market. So what we expect is that there is a real possibility of chopping. Now, if it chops, the longer it coils, the better it is for, of course, a proper market breakout. At this kind of point of data, when you're talking about what Wayne's kind of presented here, he's kind of presenting this, like that type of thing, coming into the back end. And do remember, even if you feel FOMO, there is a significant chance based on our data stats that after the Federal Reserve does place a rate cut, the market will usually drop. So whether that happens maybe a week before, whether that happens during it, remember the stats are very, very clear. after a rate cut is put in, the next couple of weeks often tend to be pullbacks. So that's something that's, I guess, interesting on the charts moving forward. But at the moment, we're chopping around. Now, most importantly, you will notice that in our last video, we talked about the idea that maybe we'd seen the first sign of weakness. The market broke underneath the 2-hour 20 moving average. Okay, it certainly did that. The market actually failed to make a new high, which was interesting. And you'll notice during the session itself, it was up, down, all around. Initially, the market rallied hugely off the Jackson Hole, came back down to this level, and then went back up. Now, I was thinking about this. If you'd place the trade, so we talked about 5,600 being a potential short position based on the last video, anywhere between 5,600, 5,610. They were a pretty good level for short. The market came down, the market went up to this level. Let's say you'd placed a short, stop obviously above here. And then it did this after the Jackson Hole and came down. Now you're given a choice. Do you want to close the position off? Yeah, you won't make any money, or you could make a couple of points, but who cares? Because it didn't do what you want. Remember, sometimes in trading, if something doesn't do what you want, but then you get such a great entry price so that you're given the opportunity to get out, sometimes you have to be able to do that. And I think especially in scalping, day trading, these types of things, this is often an overlooked kind of special property of being able to be a successful trader. You have to sometimes be able to pull the trigger on cutting your position when it comes to it didn't do what you want. Remember, if you're a believer of before Powell, you were going to say, okay, well, I think the market was going to short after that. You could have been correct. Nice. That's a great play. But to see it go initially bullish, to see IWM go 3% during this time and hold basically a 2.3% up even while the market's dropping off, this is a very bullish sign from the breadth of the market. So as it pulls back, remember, because you've got such a great entry price, you would have been able to dump the position. And I think this is kind of like, the classic type of thing that a lot of people make mistakes on. Regardless of that, let's look ahead. One day expected move low and expected high. 68% of the time, the market will stay within these ranges. There's the ones for Monday. We know that, of course, the market did turn a little bit negative last week. Very small time frame, so nothing significant yet. But if it does go back underneath 55, 60, I think that will be, again, a sign of potential gap fill. So remember those two levels we had on the SPY before, that will be important. And it could also do something like this, take a new high, then dump off. Now, if you're on a medium term, you're thinking a few months ahead. If you're investing, you're thinking of maybe even a year ahead. I don't think there's anything to be concerned about. We've talked about this several times. Look at the daily. It's so ridiculously strong. Overall, it's a very, very strong market. I do have some signs of weakness in my indicators, which basically usually point towards small drops or sideways action. And this is what we call a pullback in time. So yeah, I think we're at a point of critical, maybe don't feel fear, don't feel FOMO, just kind of look at the different asset classes. So let's speak about the options coming into Monday, because 56.50 in particular is a monster call wall. Now, I think it's a call wall. I think it'll be hard pressed for the market to get through 56.50. So if it does hit that level, that's again where bears may sit, because it's, pretty much those all-time highs. And at the same time, look at the calls. There are so many there. Then we go through, though, and we have a look at the 27th. Now, things get really weird at the 27th. What are these positions? Yeah, I don't understand what they are either. 5,700s. I almost feel like that's a misprint. But anyway, there's a lot of 5,600 kind of puts sitting there. There's a lot of calls all over the place. We'll see how that evolves for our next video, but the 27th is very strange when it comes to options. But 56.50 in particular is a huge call wall. I doubt the market will find it easy to get through that zone. And if it does get through that zone, of course, it can create a self-fulfilling positive gamma style situation where it starts to really feed upon itself upwards. NASDAQ, yep, CTAs are still really far behind. S&P 500, CTAs are really far behind. Gold CTAs are dropping it big time. So this has a little bit of concern for our current gold bullishness. Of course, it wouldn't change our medium or long term. The price action held well, but that's surprising. So they're dumping off. Silver CTAs also dumping. Interesting. And then Brent is starting to find a bit of pickup in the CTA side. Copper, I would say that's neutral as it's going back up. Let's talk Tesla now. 225 is the key level for Tesla bulls this week. Close above, start to move higher. We get into 232 as the target. not bad pickup there on Friday. It held that 210 put wall very, very nicely thanks to Jerome Powell. But this is the most important level of the week, 130. Look at NVIDIA. Look at it. It's getting struck again. Huge, massive call wall. Now, we know we're going into positive gamma past that point, and we know what's at stake. NVIDIA is going to move $300 billion potentially, according to the options market, minimum. So if we're going to move those kind of rates, those kind of money, that is huge money, then we are looking at a huge possibility of a massive positive gamma squeeze. So this is the most important level. Mark it on your charts, and of course, stay tuned to this channel because we'll be covering it. US 2-year, we can see here it dropped off. Let's have a look at the US 02Y versus 10Y, which is pretty much all we need to do for recession period timings. You can see here it dropped a little bit, but still not uninverted. Then we move over to Treasuries, held pretty well. Up 0.65 on the day, no breakout. Obviously, we know there's a lot of leverage in there. And the dollar dropped big time because basically what Jay Powell said was, well, if we get any weakening jobs numbers, which seems like we're on a trajectory now to see weakening jobs numbers for a little while, then basically speaking, yeah, the US dollar is going to suffer. And this is all part of what we've talked about for a while. A weakening of the dollar over the next 12-month period. And this will push down, I think, underneath parity and then continue on. So looks like we're moving towards parity faster than we had hoped. I would like to got another short in at around 102. But yeah, weakness in the dollar is still the storyline. Copper, no breakout yet from this high, but we'll keep watching it this week, guys. Gold doing pretty well. Gold actually managed to rally back up. You can see here the daily. And if we have a look at the weekly, another strong rejection towards the bull end. So it's still melting up, still doing well, and not a bad pair. Silver ended up closing really nicely. Great close on the weekly. Fantastic work from silver. We do like silver a little bit more than gold at the moment from a pure just kind of ratio perspective. Remember, put in your silver-gold ratios, guys. If you've never done this before, you've got to start looking at cross-asset allocations because this is how the big guys do it. They use long shorts, but also they look at, well, is it cheap compared to other things? And are we seeing momentum start to stack up? This is a great way you can do things. So let's say you were thinking, oh, I think healthcare is improving. Then you could look at XLB versus SPY, and you'll notice it's kind of consolidating. But still, healthcare has improved since July, showing that maybe, again, that late cycle stuff's coming through. You might also know that we like utilities. Well, utilities have been improving this year and, in fact, beating the SPY out in terms of pure percentage. So some interesting factors there. US oil, big break. It's not too bad. I'm still worried about US oil from the perspective of this year and elections. I think there's a lot of political power in this, but that's a great break. You know, for a day trader, for someone that's wanting to get in, pullbacks to be met by bull demand, you'd have to think when it comes to US oil. So an interesting chart there. Tesla, yeah, it's pretty good. Held 210, still up and down, inside bar. Generally speaking, 232 is our next target. Then after that, you'd be looking for the gap fill of around 246. So an interesting point here for Tesla, an inflection point. 232, could it come this week? It'll probably depend a lot on NVIDIA, realistically. Even though it's got nothing to do with it, we know that's going to drive a lot of sentiment. Semiconductors at res, no surprises, and NVIDIA at resistance as well, at that gap fill, at that resistance. And again, showing us signs of, you know, a little bit of caution needs to be taken. FOMO maybe not needed in this particular stock. You know, we were big bulls on it last, 3 weeks ago now. It went up 30%. That's a great run. That's actually a phenomenal run. Almost unprecedented. And when you think about it, this is not the stock that you usually want to be buying right now. You'd have to be patient and react and not predict. Remember, there have been other asset classes such as Russell, such as this one here. The Chinese stock market's actually improving. Look at that. Ends up pretty nicely on the week. And nice kind of close out there. Even the Aussie market here for the Australians out there, that's been improving and breaking out. Best weekly close ever, actually, on the Australian market. So very strong kind of sign for the potential movement into financials, which of course are doing well. Energy and metals also improving as we're seeing in copper. So all of these things, maybe we're seeing a bottoming of some of those, and we'll do a special on it this week. US 30, actually a little bit of a breakout after this. Again, it's not unexpected. Remember, what these type of signs show us is that we are often at periods of inflection. So we're at points where the market will chop for a while, or sometimes we actually go up a little bit and then we drop off. We used it effectively to figure out the last high before the sell-off that caused a VIX 65. And now all we're doing is we're just saying, you know what, around here, you want to be looking at different asset classes. You want to be focused on those. Now, Russell 2000 did really nicely. 221. It almost kind of worked out the way you'd expect. So Jackson Hole came out. You saw Bitcoin go ballistic. You saw the Russell go ballistic up. Our strongest sector at the moment in terms of major indices. The Qs, yeah, they went up, and same with the S&P, but they stayed within their range. So the Russell just went, yeah, you know what, I like that. And of course, it's driven by regional banks, solar, clean energy, those types of things. But 2250 still becomes the big topic here. Can we end up reaching into that? That seems to be where there's kind of a bit of res. And then will we break it? Because if we break it and we especially go through 243, which we've had on the line here before, that will start a period of strength across all of the small caps. And have a look at the RSP. The RSP is at an all-time high. This thing is going ballistic. So again, it's showing you that equal weight market. The rest of the market is starting to play catch up. The Qs, on the other hand, stayed inside the previous bar, which is interesting, creating a long leg doji on the day. It wasn't a tech-led day, that's for sure. And I think a lot of these are waiting for NVIDIA. So we'll see how that ends up playing out this week. Let's now go over to the breakout market, which is Bitcoin. Good work, guys. I got to say, nice work to you, because you were not scared. You know, we talked about the bullishness here on the Bitcoin market. So many Bitcoin bears. I don't know what was wrong with them sometimes. But, you know, people in the crypto market were freaking out. The price action told us what we needed to see. Overall, we were net bullish. I think it was like a 70 or 80% net bullish kind of, you know, position, because when the bears came in, it just looked soft and it wasn't good enough. So we broke through 64K, next level. Let's see if we can get towards 68. Of course, there's some problems around 65, which is that previous supply area. But I think 68 is very achievable. So pullbacks to be met by bull demand. Some levels to watch this week if we end up getting into them. This area in here, so about 60,500, and then of course 65. But I think 68 is a big key here. If we're able to close above that for the week ahead, or even the 2 weeks ahead, that will be a huge key towards a new all-time high on Bitcoin. And you would know if you've been watching this channel, I don't really care too much about crypto. I just think that you're better off just focusing on the asset classes that make sense at the time. And in this case, you know, of course, we do love Bitcoin, we do love Ethereum, but if you ask me about some of the like Doge and stuff, I'm not going to say I like it because I think it's a crapshoot. But either way, you know, these are the things that you just want to be looking at the price action and leaving your opinions at the door. And that's the most important thing. Let's have a look at Ethereum. Well, that's a nice breakout. It's not super strong compared to Bitcoin, but it's to be expected. Ethereum comes second, Bitcoin goes first. So decent improvements here across the crypto market. We'll keep watching that story as it evolves. Bank holiday for the UK on Monday, guys. Just be aware of that. Then we have a bunch of information for the Australians out there. CPI will be interesting read. That's coming out this week. We've got the GDP. Don't worry about that. They already can work robots on that one, so they know what that looks like. Wall Street does. And we've got core PCE, often considered one of the most important reads for the Federal Reserve on Friday. But let's make it clear. Nothing really matters this week except for one thing. Now, if you can guess what that is, put it in the comments down below right now and pause. But otherwise, yeah, of course, it's NVIDIA. Thanks very much, guys. I hope you had a great weekend so far. Have a fantastic day. And remember, subscribe to the channel. Follow us on some of the other socials. And if you're in Sydney, come out and check us out at the Financial Magnates Conference this week, 29th of August. I'll be doing a speech there. I believe it's free to attend. So love to meet you guys. Sydney, Australia, this week, Thursday. Catch you guys. Bye for now.